One of the best ways for companies to return cash to investors is simply buying back stock. So when you generate free cash flow, you have excess cash on the balance sheet, you just go buy shares on the open market and the number of shares outstanding declines. Your earnings per share go up, and actually every owner of the stock owns a little bit more of the company every time you do that. There are some companies that are buying back stock at an incredible rate. And I wanted to go through 5 companies that I think are really well positioned that are buying back incredible amounts of stock, up to 20% of shares outstanding on an annualized basis. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Now, for those of you who are familiar with this channel, this first one isn't going to be a surprise. That is General Motors. General Motors is a company that has been generating positive free cash flow for years. As much as there is negativity around GM stock on YouTube, in kind of the financial media, and really investors aren't putting a lot of stock in it either. Shares trades for about 5 times earnings. But this is actually a very steady company, and it's actually in a market that's getting less competitive. Trucks and SUVs are not getting a lot of new competitors, whereas electric vehicles, tons of competition coming into that market. So if you think about if you want a cash flow positive business, do you want more competition or less competition? GM, I think, is really well positioned on that front. Shares are trading for a very reasonable valuation. As I'm recording right now, the stock is trading for just 5.2 times trailing earnings. And look at this free cash flow chart and the amount of share buybacks the company is doing. Now, keep in mind that the market cap of General Motors, as I'm recording, is $53.3 billion. So a $10 billion buyback is going to be about 20% of the shares outstanding. That's basically the pace that the company is on right now. Announced a $10 billion buyback late in 2023, and then another $6 billion buyback program a couple of months ago. So these buybacks are going to continue, and the question for investors is the free cash flow going to continue? Are margins going to remain relatively high? I think this company is going to do relatively well, even if we do go into some sort of shallow recession, in part because it's not as competitive a space as something like electric vehicles. I would much rather be in trucks and SUVs, where those high-end consumers who still appear to be buying vehicles, buying high-end goods, they're going to be buying Chevy Tahoes, Cadillac Escalades, those kind of vehicles. That's what ultimately drives the company's free cash flow. And you get the optionality of owning Cruise basically for free. So that's upside that you get from GM stock. I love the risk reward there, and the buyback is really the icing on the cake. The second company is Archer Daniels Midland. This is a agriculture related company. So they do all kinds of things in the agriculture business. They're selling seeds, they're transporting product, they're a commodity supplier. But at the end of the day, this is a steady business because people need to eat. Just keep it simple. That's the bottom line. Price earnings multiple is relatively low again, not quite as low as GM, but 12 price earnings multiple as I'm recording right now. And look at this chart of the company's free cash flow. Now, that free cash flow is volatile, but it is positive free cash flow each year on a trailing 12-month basis since 2022. And what are they doing with that cash? They're buying back a tremendous amount of shares outstanding. Just over this period of time, which goes back to June 2022, the weighted average shares outstanding declining on a compound annual growth rate of 4.4%. If we just look over the past year, the shares outstanding down about 6.2%. So just a tremendous amount of shares being bought back for a company with a market cap $28.5 billion as I'm recording right now. So if those buybacks continue, this can be another company that just continues to steadily buy back shares. And if we're just looking at compounding a 10%, a buyback that is 10 to 15% of shares outstanding on an annualized basis, that alone can generate a phenomenal return. And I think, like we're seeing in the auto business, where GM's in a relatively good position with trucks and SUVs, Archer Daniels Midland is making and selling a product that we're going to need for the foreseeable future. As long as people are eating, the services they provide are going to be needed in the market. It is a very competitive space, but it's also a very difficult space to break into just because of the capital requirements that are required to get into the agricultural business. So this may be a bumpy ride ahead for Archer Daniels Midland, but I think this is another company that can buy back a tremendous amount of stock for the foreseeable future. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Another business that's really unloved by the market right now is the rental car business. And Avis Budget is another company that's generating strong positive operating cash flow, and they're using that money to buy back stock. Now, the rental business is a little bit different because if you're going to increase your fleet, you are going to need to spend money. You oftentimes do that with a lot of debt. So there is leverage on the business. There's risk to operating this business. But let's look at some of this information. They had negative free cash flow in 2022, but you can see that that has improved dramatically over the past year and a half. Now, this is pretty similar to the trends that we see at Hertz. Hertz was actually in a little bit worse position than Avis Budget was, but they have been buying back stock at a really rapid rate. This is the cash from operations right here, $3.5 billion worth of cash from operations. Now, the reason that free cash flow is negative is because they're spending more than that on capital expenditures. Those capital expenditures need to be covered by debt. So that's the dynamic in the business. But management thinks that the debt that they're taking out, which is backed by the vehicles that they own, is an appropriate use of capital because there's a return on that investment. And if there's an excess return, they can simply buy back shares of stock. And the current price for the stock is relatively attractive. As I'm recording, price to earnings multiple on a trailing basis anyways, just 3.2. And on a forward basis is 6.3. Again, this is some of the ebbs and flows that we see in the rental business. The dynamic that has really hurt all of these rental companies over the last few years is they were buying cars relatively expensively during the pandemic or late in the pandemic, that 2021, 2022 range, when they had to ramp back up the number of vehicles. People started traveling again. So they were buying vehicles at an expensive price, and then they were depreciating very quickly. So that when they went to sell them into used car markets, the value had dropped. And so that creates a financial loss, or you have to increase the depreciation that you're putting on each of those vehicles. That dynamic should change over time, and that free cash flow and that operating cash flow and free cash flow should be a little bit more predictable. So I think with shares down sharply from where they were in 2022, shares outstanding are down over that period of time as well. And if management keeps buying back stock, this is a company with just a market cap of about $2.5 billion. So if they keep buying back a significant amount of stock, you can reduce those shares outstanding, potentially each share will own much more of the company in the future. And if the rental car business gets back to normal, which I think all of these companies think it will over time, then we should see some of those operating numbers improve pretty quickly. I think Avis Budget is going to be one of the beneficiaries. There's a ton of scale in this business, and there are only a handful of companies that have the scale to operate. This is one of them, and they've done a much better job with their capital expenditures and buying the right vehicles compared to Hertz over the past few years. So that's why Avis Budget is one of the companies that I'm keeping an eye on from a buyback perspective, because their shares outstanding are down an incredible 20% on a compound annual growth base since 2021. Now, buybacks have become much more popular over the last few years as a lot of companies have been kind of forgotten by the market. Companies that are trading for less than 10, 15 times earnings. I think if there's steady free cash flow and they're buying back stock at a rapid rate, that's going to be a really good move as investors kind of shift back to some of those unloved companies. If you're not an AI company or you're not a tech company right now, more than likely, the market has kind of forgotten about you. And I think all of these companies kind of fall into that category. So if multiples rise over the next few years, but it just so happens the share count has fallen 30, 40, 50%, that is going to be a huge win for investors. So let me know what you think of these three stocks: GM, Archer Daniels Midland, and Avis Budget. What do you think of their buybacks? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.